Guys, when I say that the fallout of this FTX implosion is going to be massive, I absolutely mean it. So, Sam Bankman-Fried put out a tweet storm today, like 22 tweets in this thread, talking about how he's sorry and that the first thing on his mind is users' funds. But the Wall Street Journal put out an article this morning giving absolute details about what went down, how this all happened, and what the ramifications most likely will be from all of this. Because when I initially looked at this, I thought that the hole that was created by FTX was only $2 to $3 billion, whereas now what we're seeing is that it was actually closer to $10 billion, which is just absolutely ridiculous. So let's get into it. I'm going to read this article to you guys and kind of give some of my insights on how this all went down and different things about it, because there are some things that need to be mentioned in this that weren't, because they were trying to put out a quick article. But so let's just jump into it. Crypto exchange FTX lent billions of dollars worth of customer assets to fund risky bets by its affiliated trading firm, Alameda Research, setting the stage for the exchange's implosion, a person familiar with the matter said. FTX chief executive Sam Bankman-Fried told an investor this week that Alameda owes FTX about $10 billion, this person said. FTX extended loans to Alameda using money that customers had deposited on the exchange for trading purposes, a decision that Mr. Bankman-Fried described as a poor judgment call, according to the person. So, in their terms of service, it specifically says that they will never use customer funds to make investments. And that is exactly what this article is saying. So not only did they break their terms of service, they actually broke the law by doing this. After and this will be talked about a little bit at the end of this article, but there was actually another firm that did something similar to this in the stock market a few years ago, and they faced huge repercussions from the US government. All in all, FTX had $16 billion in customer assets, according to the person. So FTX lent more than half of its customer funds to its sister company, Alameda. An FTX spokesman declined to comment, go figure. FTX paused customer withdrawals earlier this week after it was hit with roughly $5 billion worth of withdrawal requests on Sunday, according to a Thursday morning meeting from Mr. Bankman-Fried. The crisis forced FTX to scramble for an emergency investment, which did not pan out. FTX struck a deal to sell itself to its giant rival Binance on Tuesday, but Binance walked away from the deal the next day, saying FTX's problems were beyond our control or ability to help. So obviously, way worse than $2 to $3 billion hole, because I think that Binance probably could have covered that. The failure of FTX to fill withdrawal requests shocked crypto investors and badly tarnished the reputation of Mr. Bankman-Fried, who had embraced regulation of digital currencies and branded himself as a crypto entrepreneur driven by ethics and philanthropy. The absolute just irony in that entire statement is hilarious to me. I mean, yes, he did say that he was ethically driven and that he wanted to follow into a route of more regulation and more oversight, and yet his company that he was running had no oversight, was not transparent, and was very poorly regulated. So the fact that he was trying to push for this, it's like saying one thing and doing the exact opposite here. So because of that, he's very much a hypocrite. An exchange really shouldn't have problems getting its customers their deposits, said Francis Coppola, a UK-based economist. It shouldn't be doing anything with those assets. They should literally be sitting there so people can use them. As questions were brewing about FTX's health on Monday, Mr. Bankman-Fried tweeted, "FTX has enough to cover all client holdings. We don't invest client assets, even in treasuries." He later deleted that tweet. Yeah. Yeah. He deleted the tweet saying that they had enough to cover client holdings. Again, this is another example of him saying one thing while doing the exact opposite. He knew that he had given away those funds to Alameda Research to place shady trades. He knew that, and yet he said that they had the funds necessary to cover all of their users. On Thursday morning, Mr. Bankman-Fried said in a tweet that Alameda Research was winding down trading. Good. Okay, let me stop here again real quick, because I just want to point out that an exchange should never be tied to a trading fund or a trading firm, because they would get insights into people's activities on the exchange that nobody else has. And that in itself is just very, very shady and very much a gray area. But it's on the side of the gray area that you never should touch, because you're basically making the market using your own platform. And that should never be done by anyone. In traditional markets, brokers must keep client funds segregated from other company assets, and regulators can punish violations. In 2013, for instance, and this is what I was talking about earlier, the Commodity Futures Trading Commission fined brokerage MF Global $100 million for misuse of customer funds during its messy collapse 2 years earlier, a downfall also driven by risky bets gone wrong. But MF Global customers were ultimately made whole after a years-long bankruptcy process. With FTX operating in the Wild West of crypto, it is unclear whether customers will ever get their money back. The revelation of the loans suggests that the root of FTX's downfall lay in its relationship with Alameda, a firm known for aggressive trading strategies funded by borrowed money. Some crypto traders have voiced wariness of the affiliation, worrying that it posed a conflict of interest for an exchange to be attached to a trading business, just like I said. And another thing that I want to mention here is that everything that we've seen as far as the downfall of crypto this year has been attached to some form of leverage. When a trading firm or an exchange or any type of platform or protocol uses leverage to boost its profits, that's when we've seen the biggest implosions of these platforms, these assets. Like FTX leveraged user assets on its platform Alameda Research. Three Arrows Capital over-leveraged itself with Luna. Luna itself over-leveraged itself. And we see this time and again. So what does that tell us? It tells us that we need to make sure that we are not propping up these platforms that are using leverage to gain more profits. We need to shun these platforms. Okay. Mr. Bankman-Fried founded and is the majority owner of both firms. He was CEO of Alameda until last year, when he stepped back from the role to focus on FTX. Alameda's CEO is Caroline Ellison, a Stanford University graduate who, like Mr. Bankman-Fried, previously worked for quantitative trading firm Jane Street Capital. Alameda is based in Hong Kong, where FTX was headquartered before relocating to the Bahamas last year. In theory, exchanges like FTX make money by allowing customers to trade cryptocurrencies and collecting fees for transactions. Alameda pursued a variety of trading strategies to make money from volatility, a riskier business model. Among the strategies that Alameda engaged in after Mr. Bankman-Fried founded the firm in 2017 was arbitrage, buying a coin in one location and selling it elsewhere for more. One early winning trade involved buying Bitcoin on US exchanges and selling in Japan, where it commanded a premium over its US price. Another business at Alameda is market making, offering to buy and sell assets on crypto exchanges throughout the day and collecting a spread between the buying and selling price. More recently, Alameda has become one of the biggest players in yield farming, or investing in tokens that pay interest rate-like rewards, according to analysts who used public blockchain data to track the firm's activities. One crypto wallet controlled by Alameda has generated more than $550 million in trading profit since 2020, according to blockchain analytics firm Nansen. Yield farming can be risky because the tokens often have an initial run-up in price as investors pile in seeking the rewards, then a crash as they get out. And that's exactly what we've seen with a lot of these yield farming tokens. They're just farmed tokens. That's all they are. A lot of these DEXs have done this. A lot of these DeFi protocols have done this as well. And so if they were using their leveraged assets to go all in on DeFi, then they were absolutely wrong. On top of that, using user funds to do so, that's just a double negative and was very, very silly to do so. It's essentially like picking up pennies before a steamroller, said independent blockchain analyst Andrew Van Aken. You use dollars or stablecoins to get these very speculative coins. Yeah. So there's a lot to be said here. There's also a lot of other things that are going on in the background. People are speculating that this goes all the way back to Gary Gensler and the SEC, the CFTC, not doing what they were supposed to do. There are a lot of people speculating that they knew what was going on at FTX and did nothing because of his parents and their affiliations with all of these people in the government. And you know, it wouldn't surprise me one bit if that were true. Also, Sam Bankman-Fried's tweet, his thread that he put out today, he said, it's pretty funny. Kobe had a great response to this on Twitter. Definitely go check it out if you haven't already. But Sam Bankman-Fried basically said in one tweet, "I'm sorry." And then in the very next tweet, he said, "Anyway," and then went on to talk. It was very funny. Kobe posted a meme, like basically showing that game show host saying, anyway. It was really funny, but none of this is funny, obviously. Like, all of this is terrible for the market. It's terrible for the users that were using FTX, and so I apologize to all of you users out there that were using FTX to store your assets. This is definitely a good example of why you should never leave assets on a centralized exchange. You should be making sure that your assets, your crypto assets, are secured. And that's why I use Ledger hardware wallets. And I actually have a link in the description below if you would like to pick one of those up today. I highly encourage it. Definitely pick up more than one if you have different security boxes scattered around your house like I do. Definitely pick up more than one so that way you can back up those assets. It's always a good idea to do so. But that's going to be it for this one, guys. Thank you for watching. Crypto Clay out.